Hi everyone, we're going to continue on in the series of videos here looking at the homework problems for chapter 9 and 10. And in this specific video, we're going to look at 10.1. And in this specific problem, again, it's in your packet, but I pulled out the details here and we can solve it in Excel together. And what we're looking at here is a bond type problem, bond issuance at a discount, right? So it's at 95. We have 5 years of payments, and it's paid twice a year on 6/30 and 12/31. Principal due at maturity, and so on and so forth. So, and then we're going to have to complete this carrying value / unamortized discount table as well. So let's get into it. Okay. So the first entry that we're going to need to record, I'm just going to copy it out of the words here, is on January 1st of the first year. And we issued, let me delete this out. Oh, and then it gets, shoot. Sorry, bear with me for one moment. Okay. Okay, just a little cleanup here. You won't need to do this when you get your version of the template, as long as you're downloading that after I've completed the video here and all that. But yeah, so okay, so the first thing we want to look at is we have this bond issuance, and it is at 95, right? So I'm actually gonna let me write this out. So bond amount, we'll put in 2 million. I just want to kind of do this calculations to make sure that you all understand. So that, as the face amount of the bond, they call it, is 2 million. So it's a term is 5. We'll say 5 years. Number of payments is twice per year, so we can equals 5 times 2, so there will be 10 payments, and that's what's basically listed out here, 10 payments. The interest rate is 0.07, and that's annual interest rate, right? So maybe I'll put that in there. That's annual. Now, because we're making, so interest rate per, let's say per payment, because we're making twice a year payments, we're going to divide that by 2, right? So it'll add up to 7% over the year, but we're making 2 payments, so it's going to be divided by 2. So each time we make our semi-annual payment, we're going to have 3.5% interest that we recognize, or that we have to pay. And yeah, I think that's pretty much all the information that we really need here to be able to do our calculations and all that. But let's get into it and see if there's anything else that might come up. So let me just do a little table here. I'll leave this in your version of the template so you can fill this out as well. I think that's handy. Okay, so the first thing we want to do is we want to note that we bonds payable. And so we got some cash, and we had some amount of bond issuance, right? And that was $2 million. So if we didn't have a discount, we would have just basically received $2 million. Whether we're the business, so we're basically borrowing $2 million, through these bonds. But we issued them at 95, right? Okay, maybe that's actually good information to keep in here. So let's do a couple more things. You know what? Actually, bear with me here. I'm going to just do this as well. Merge these cells real quick, because I think this additional information will be valuable, hopefully, to explain the problem here. And so let's put issued at, and we'll say 95. And I am just going to write it out as 95% because that's, I think, a pretty easy way to think about that. So then that means that the discount equals 1 minus, the other part of 100%. So 5% is the discount. And so then the discount, we'll say discount percent, and then the discount dollars equal 2 million times 5%. Format paint that, or $100,000. Okay. So that's what we should receive then, that's what we'll book as the discount on bond payable. If I can type. Okay, and then again, like I mentioned earlier, we don't get the full amount of cash that we would have had otherwise because we're giving the discount, so we only receive 1.9 million in cash for our purposes to be. We'll just call this bond issuance. We'll put in the details: 5-year, 7%, say at 95. That's some good info. Okay, so here's our initial journal entry. Like I said, we received less cash than we actually would because we gave a discount for this. And then that looks good. We can let's do the journal entries and then we'll fill out this table after that. Yeah, let's just do it that way. Okay, so add interest. So now we're going to record the journal entries at 6/30 and 12/31 of the first year. And so I'm just going to take these journal entries to borrow the format. And like we said, the first one was at 6/30. So let's update the date. And then the second one is at 12/31. So these are the two interest payments in that first year. And let's update all this information needs to be changed. But we have interest expense we're going to record. And then we'll delete out this other stuff as well. And the journal entries are going to be the same between them. So actually, I'm just going to do this. I'm going to say equals that, equals this, whoop, and then equals. Now there's nothing in there right now, but there will be, all the things here later and I'm also going to do it. I'll do it after we finish the journal entry. But okay, so we have the interest expense. We have cash that's going to be paid. You can see that updated, so it's got the same journal entry. Pretty cool. We have cash that's going to be paid, but then we have a discount amortization that's going to make the interest expense go up. So when it comes to the amount of interest to be paid, we take the 3.5% there, per payment, interest rate per payment, times the bond amount of $2 million. So that's 70,000. Was that? Oh, I think I just accidentally. Let me delete this out again. You'll have a cleaned up version when you see yours, so don't worry about that. Okay, so we have 70,000 again. That was the bond amount times the interest rate, 7% per year or 3.5% semi-annually. And then we need to amortize our bond discount as well. So let's calculate. So the bond. So let's say discount amortization. There we go. Again, this will be all completed when you get your version, and you'll have a column for that, or a row for that and everything. But we have the number of payments is 10. The discount we got was 100,000. So let's divide that by 10 payments. So it's going to be 10,000 per payment essentially, and we're going to want to credit. I'm just going to equal, let's just equal above. But let's indent. So it's crediting now. The first thing we did was to debit the discount, but now we're going to credit it as we're reducing the amount by $10,000 each payment period. And then we just add these together to give us our total interest expense of $80,000. And we'll say interest, we'll just say bond interest payment. Let's format paint so these get the same style. But everything here is going to be the same as time proceeds. There's, this just happens over and over again, essentially for 10 times. And it's that straight line amortization of the discount that we're accounting for. And now we're going to record in this table. Oh, here I would ask this: what is the total amount of interest expense incurred over the life of the bond? And so really what we can see is it's $20,000 per year. And so maybe I'm trying to think where it would be a good spot to put this in. Yeah, again, you'll have this available for you when you watch the video and do the problem here. And let's say I'm gonna copy this in here. Okay, let me merge and center that. Okay, so here's number, question C. And so the total amount of interest expense incurred over the life of the bond then would equal the $2 million times 7% per year times 5 years, right? So the total expense over the life of the bond then would be $700,000 essentially. Let me make that look a little better with formatting. Okay, and I'll leave that formatting. So when you do your calculation in there, it should come out just to be the same as that amount there. And so that would, or what, actually, shoot, I should say this will be the amount of the interest paid. What is the total amount of interest paid over the life of the bond? So that would be $700,000, based on the actual cash payments. Where am I getting off here? Wait a minute. I think, did I do that right? Oh, 2 million. So 2 million times the 7% times 10. Okay. Is that all equal? I feel like that is making me question my math here. Yeah, okay. So that looks good. So 700,000 would be the total amount of interest paid over the life of the bond in cash. And then let's also include, but here, if we're going to say what is the total amount of interest expense over the life of the bond, including the discount on the bond payable, because the discount on the bond payable increases the amount every time by $10,000 basically, is you could take this plus that discount amount. So the total will be $800,000 of interest expense recognized over the life of the bond. And we'll say including discount amortization. So those are two different sort of things that, hopefully that makes sense, because what we're doing is increasing our interest expense every period to account for that amortization. Just kind of make this a little, I gotta zoom out. Okay, this thing's getting crazy. There we go. Okay, so here, this is like C, I'm just going to call this C1, and then down here we're going to call this C2. And so you can kind of see, again, sorry, bad pun, but here interest expense every time is $80,000. We're going to have 10 of those payments, and so 80 times 10 gets us to 100,000. But the actual cash interest paid is just the 700,000, and so the extra 100,000 in interest expense over the life of the bond comes from the fact that we had to incur a discount in order to sell, issue this bond and sell the bond, and so we're just recognizing that expense of that extra 100,000 in the difference between the cash that we actually received and the amount we'll eventually pay back over the life of the loan. So So the cash we pay is only 700,000, just like you can see, it's 700 times 10. But the total amount of interest expense, we have to add an extra 100,000 to account for the discount there. Okay, so that's great. Let's see. Okay, so we need to fill out our table here is the last part of this problem. And so the unamortized discount when we begin is, again, that 100,000, right? And then the carrying value of the bond includes, or sorry, I should say, because it's a discount, it will be reduced for that discount amount. So the carrying amount then is the 1.9 million, which subtracts is the 2 million total bond amount minus the discount. And then every time we make a payment, the bond discount is going down by 10,000. So it goes down to 90,000. I'm just going to link it over here actually and click F4 because it's going to be the same reduction every time. So whatever cell above minus the locked, with the dollar signs that locks it to 10,000. And then I could just drag that down. You'll see it eventually go to 0. And then the carrying value of the bond will increase as the, whoops, I should do that differently. Here, let me lock this. So this cell locked minus the 90,000. So the actual carrying value then increases every period as up to its full value when the discount's gone. So it's really just the interplay between the discount and the carrying value of the bond that changes over time. When we get to the very end of the bond and we pay it back, it's the full amount of the 2 million, and we have to pay that amount, back at maturity, essentially. So yeah, that pretty much captures, I think, all the parts of this problem. And hopefully that was helpful. I know these problems can be a little tricky, but I think writing out the details and kind of just having all this information at hand makes it hopefully a little more clear. And does it ask us to do the payment at maturity? No, I guess it doesn't. I mean, a lot of the problems do ask that. If we did want to record it, it wouldn't be difficult. It's just 5 years later, right? So let's just do this real quick just to record it for the heck of it. So the last entry that we would record is 5 years later. So on this date, the payment has the bond has matured, and we need to pay this thing out. And so we credited that liability to make it increase, but now 5 years later, it's time to repay this money to the bondholders, and we have to repay the 200,000. So we only got 1.9 million because it was the discount, but we have to repay the full balance of the 2 million. So that's where that discount really comes into play. It is, kind of an expense, right? We recognize this hit to our financial position. The discount expense will drive up interest expense basically over those 10 payment periods. So we do end up taking that discount. This is on the balance sheet, but it gets amortized through to the income statement over the life of the bond, basically. So great. All right. Well, hopefully that's helpful. And let's take a look at the next problem in the next video, and I'll see you there. All right. Thanks, everybody. Bye.